All right, hello again, everybody. This is Mike with the Netpicks Inner Circle. In this week's options trade of the week, I'm going to take a look at CMG, which is Chipotle. We are in the middle of earnings season at the moment, and many of the individual stocks on our list have had some pretty big moves because of those earnings. CMG is one of those. It came out with earnings here over the past 24 hours, and today alone, the stock is up almost 25%. It's up over $83 a share. It's been an extreme move. You don't see these types of moves all that often, and when they do happen, it's normally a move related to earnings. That's exactly what's happening today. So what I'm going to do is take a look at the daily chart to start with, and that's what you're seeing here on the screen. You can ignore the indicators down at the bottom. We're not going to use those here for today's trade. I want to focus your attention on price action up above. You can see it, and it's no surprise, with a 25% move intraday, we're overbought in the near term. Okay, and it's been an extreme move. Now, I have some indicators on this chart helping to identify those extremes, and you're going to see the red, the yellow, and the white lines on the chart. Those are standard deviation channels. They help me identify those extremes in the near term. So you can see on this move to the upside today, we just touched that upper red line. That's the second standard deviation channel that I have on my chart. So it's a 2 standard deviation move here today on the upside. When that happens, when you start to see that type of a channel hit, doesn't mean that CMG can't move higher from here. It just means going forward, it's going to be more difficult. The odds just don't favor a continued push to the upside from here. More often than not, when you hit this type of an extreme, you'll see a period of consolidation kick in. You could potentially even see a pullback. So I want to position ourselves with our trade of the week here today with a neutral to slightly bearish trade. I'm trying to take advantage of a slowdown after the big earnings move on CMG. Now I could also take a look at the 195-minute chart. You can also see there, it gives you 2 candles a day instead of 1 like we see on the daily chart. You'll also see that we hit that second standard deviation channel today as well. So an extreme on many different time frames, and that makes sense when you start to see a 25% move in one day. It's a very unusual type of an event. So let's go over to the trade page and let's talk about piecing a trade together here. Let me shrink this stuff down a second. Notice the IV percentile down at the bottom is at 51. Anytime that you see an IV percentile above 50, that indicates to me that volatility is high. When the volatility is high, because it's such a big input in the pricing model of an option, when the volatility is high, the prices of the options are going to be more expensive. That is typically a sign for me that it's time to sell premium. Let's take advantage of selling an option or selling a spread because we can collect more up front for that type of a trade. We'll talk about that more in just a moment. So with that IV percentile at 51, it's very unusual to see the volatility elevated after the earnings are already released. Going into earnings, the market makers will pop up the volatility to start to price in some of the uncertainty. No one knows what the earnings are going to come out as, and no one knows what the market's reaction to those earnings will be. Well, once the earnings are released, they typically suck the volatility out of the options because now the uncertainty is gone. Everybody knows what the reaction was. Well, in this case, the volatility in CMG is still elevated. It's still right around 50. So it tells me that there's still some good premium left in these options. That's why I'm attracted to this type of trade that we're going to talk about next. Not only do we have a chart extreme and looking at the price of the stock, we also have the volatility at an elevated level. There's a big opportunity for us to take advantage of that here over the next couple of weeks. So I want to take a look at selling a call spread. A lot of times people get intimidated by selling options because they think it's a risky approach. You have a lot, just undefined risk. Well, that's certainly true if you just sell a naked option. If all I did is come in and sell just an individual call, it's going to tie up a lot of capital and I'm going to have essentially undefined risk on the trade. In this type of market where we've seen a lot of big moves in both directions here over the past couple of months, I don't feel comfortable carrying unlimited risk overnight. I would much rather be in a risk-defined trade, and that's what we're able to get when we sell a call spread. So we're going to take a look at the May monthly options. They have 22 days left to expiration. When I sell a call spread, I want to go to the out-of-the-money options. I want to take a look at the junky out-of-the-money call options that have a very low probability of success. If I was just expecting CMG to move to the downside immediately, I could buy a put and have way more profit potential on that trade. The problem is I only have one way of making money on that trade. I would need CMG to move to the downside immediately. Well, I'm not so convinced that it's going to turn on a dime here. I could certainly see CMG just drifting higher for the next couple days, or even just settling into a consolidation before the move to the downside. So by selling the call spread, I still have a bearish trade on. I still make money if it moves to the downside, but I just give myself more ways of making money. And let's talk about that right now. So I'm going to go to, let's go ahead and pop up the trade down at the bottom. I'm going to take a look at selling the 435, 440 call spread. Okay, let's take a look at where that's trading. It's currently trading for $2 or $200 per spread. So I'm selling the 435 call and I'm buying the 440 call to make it a risk-defined trade. Okay, let's go ahead and click on confirm and send. Let's break this trade down a little bit. So the $200 per spread that I collect is the most I can make on the trade. That's my maximum profit potential. Now, you don't need to be intimidated by this type of a trade. If you take a look at CMG and say, okay, it's a $300 stock, I don't have the account size that can afford that type of a position, well, take a look at my maximum loss. The most I can lose on this trade is $300. Even if we're dead wrong and CMG continues to make a big move to the upside, the most I can lose on this trade is $300. So it's a very reasonable trade regardless of account size. My break-even point would be at 437. That is calculated by taking my short strike. So the 435 call that we're selling, we're going to add on the $2. That gives us our break-even point. So I don't care if CMG moves slightly higher from here, if it moves straight sideways, or if it moves lower. As long as it stays below that number, I can make money. So it literally gives me $13, $12 to $13 up above the current price, and I can still make money. So I can be dead wrong by $12 or $13, and I can still make money on the trade. I also make money from time decay adding up. I also make money from volatility decreasing. Remember, we mentioned the volatility is still elevated. So if that starts to decrease going forward, I can make money from that as well. So I have 5 different ways of making money on the trade. You're looking at this saying, okay, you're risking 300 to make 200. That ratio doesn't make sense. That's not what I was taught initially. Well, the reason we're willing to accept that bad risk to reward ratio is we have those 5 different ways of making money on the trade. Because our probability of success is pretty high here, I'm willing to sacrifice the positive risk reward scenario. Okay, so on this trade, what's the ideal scenario for me? Well, in a perfect world, if CMG continued, or if it just rolled over and moved to the downside immediately, that's the ideal scenario. I can make money from that. If we kind of drift lower to sideways, I'm okay there too. If we even start to drift higher over the next couple days again, I can make money there as well. So we're really giving ourselves multiple ways of making money on the trade. Now, let's say we get filled here at $2. How do I manage that trade? What are the rules that I follow on that trade? So whenever I sell a spread like this, my profit goal is 50 to 75% of whatever I collect to put the trade on. The $2 is the $200 per spread. That's the most I can make on the trade, but the only way I get to achieve that full profit is if I hold to expiration. The problem with that is the closer we get to expiration, the options are going to react faster to changes in stock price. It's called the gamma risk, and it increases the closer we get to expiration. So what I would hate to have happen, with 22 days left on this trade, let's say that we're profitable for the next 15 days. Okay, we've got a really nice profit. We want to hold the expiration, just let the whole thing expire worthless and keep our full profit. Well, what happens in the last 5 to 7 days if CMG decides to bounce again and starts to move back to the upside? I could go from a full profit, essentially, to a full loss almost immediately. Not willing to run that risk. So oftentimes what I will do on these trades, if I can buy this thing back for between 50 and 75% of whatever I collected to put the trade on, that's what I'm going to do. Book the profit, free up the capital for the next trade, and move on. Now, the benefits of holding to expiration is you could let the whole thing expire worthless and not pay the commission to close out of the trade. I just don't like to do that all that often. So on this trade, if we collect $2, I'm going to see if I can buy this thing back for between 50 cents and $1. That would give me between $100 and $150 of profit potential. So that's the ultimate goal here over the next couple of weeks. The beauty of these trades, and this is why I love to use these in my own trading on a regular basis. When I sell this spread, it's not something that I have to sit there and watch all day long. maybe come in once a day, check the trade, and that's it. Because the time decay is working in our favor, the longer we hold the trade, the more the time decay helps us. Right, so we have a lot of different routes to go here to hit our profit goal. It's a perfect trade for somebody that's working a part or a full-time job, because you don't have to be there all day long. Or, going into the summer months, maybe you just don't want to be in front of a computer all day long. I don't blame you there at all. This is a trade that we can get on. We've got $200 of profit potential over the next 20 days. I'm only risking $300 to begin with. So, you could put this thing on a couple of times and you're talking about, what, $400 to $600 of profit potential. That's a nice little boost in your income on one trade over the next 20 days. And I have 5 different ways of making money on the position. We're lining up a lot of different factors in our favor. That's why I love to sell options and sell spreads like this. So we'll continue to track this over the next couple of weeks. When we come back next week for our next trade of the week, we'll recap this, see how it's working, see what's happened between now and then, and potentially manage that trade accordingly at that point. So if you have any questions on this trade, certainly send me an email or post a comment here in the blog, and I will get back to you right away. Before we wrap up this video, let's quickly talk about the trade from last week. And actually, we're going to go back to IWM. We ended up selling a call spread on IWM utilizing the April 27 weekly options, and we sold the 156, 157 call spread. Now, when we put this trade on, we collected 38 cents or $38 per spread to put this trade on. Okay, so we sold the 156 call, we bought the 157 call to make it a risk-defined trade. The 38 cents that we collected to put the trade on, that's the most I can make on the trade. Well, we ended up closing out of this trade here earlier this week. Sent out the alert to our students. We bought it back for 9 cents. Okay, so we booked the profit on this trade, and we booked around a 29-cent profit on the position. Okay, so it gave me a really nice profit. The reason I closed it out early, early this week, we had the nice move to the downside. That started last week. It carried into early this week. So I decided to take advantage of the weakness, book the partial profit, and avoid any type of a bounce that could potentially come. With the market oversold to start the week, I decided, okay, let's go ahead and book the profit. We got the move we were looking for. Let's free up the capital and move on to the next trade. So we closed it out for 9 cents. It was a $29 profit per spread. The beauty on that spread is we only tied up $62 of capital to begin with. So for every spread that you sold, it requires $62. So it's a very small trade. You can take it with 10, 20, 30, 40, 50 contracts if you had the account size. It's a very liquid product, and in this case, just a really nice profit was booked, and we just continue the really nice stretch here with our trades of the week. So that trade has now since been completed, and we'll focus our attention on the CMG trade that we just talked through here earlier. Again, if you have any questions on any of the trades of the week, feel free to send me an email directly. Mike@netpicks.com is the email, or just post a comment here in the blog, and we'll get back to you here right away. So let's see what happens over the next week or so. We've seen some fireworks in both directions on many stocks over the past couple of weeks, so we'll see if we start to get some consolidation to kick in. All right, I'm going to go ahead and wrap this video up here. I'll be back here next week for our next options trade of the week. We'll talk to you then.